Two approvals landed in Canada on Friday. One was expected, one was not. Ottawa greenlighted Enbridge's $4 billion Sunrise natural gas pipeline expansion in British Columbia, adding 300 million cubic feet per day of capacity to the West Coast system. Prime Minister Mark Carney signed off on it as a signal of purpose, in the words of Enbridge's own executives. Construction begins this summer. The TSX ended the week slightly negative, with energy dragging indexes lower even as the pipeline headline moved through the wires. That disconnect between a landmark infrastructure approval and a falling energy index was the first strange note of the day. The second approval was quieter and bigger. Toronto-headquartered Cohere announced a merger with Germany's Aleph Alpha, creating what the two companies call a transatlantic AI entity, anchored in both Canada and Germany. The financial terms were not disclosed, but Schwarz Group, the German retail conglomerate and Aleph Alpha shareholder, committed €500 million to back the combined entity. That is not a rounding error. That is a strategic bet. All of this happened on a week when Prime Minister Carney sent invitations to 100 of the world's largest investment firms, pitching an Invest in Canada summit for the fall. Canada-Mexico coordination on USMCA talks was confirmed, with a Mexican trade mission headed to Montreal and Toronto in early May. Air Canada announced it is scrapping its JFK and Salt Lake City routes as Iranian war-driven jet fuel costs have doubled. The S&P TSX Composite ended the week modestly in the red for the second straight session. The market moved sideways, but underneath it, something structural shifted.
The standard reading of the Cohere Aleph Alpha deal is a defensive merger. Two second-tier AI players combining to survive against OpenAI, Google, and Anthropic. That reading misses the point. Cohere CEO Aidan Gomez framed it differently. Organizations globally are demanding uncompromising control over their AI stack, he said. That word, control, is the operative one. The combined company is not trying to beat US big tech at consumer AI. It is targeting a specific gap: enterprises in regulated industries, banking, healthcare, government, that cannot route sensitive data through American cloud infrastructure. The European AI Act, national data sovereignty rules, and post-Snowden procurement requirements have created a compliance floor that US hyperscalers structurally cannot clear for certain clients. Aleph Alpha was already embedded in German government AI procurement. Cohere was already running enterprise deployments across financial services. Together, with €500 million from Schwarz Group, the parent of Lidl and Kaufland, one of Europe's largest private companies, the combined entity has distribution, capital, and a regulatory moat that is genuinely difficult to replicate from Silicon Valley. There is a historical analog. When ARM Holdings remained UK-headquartered through multiple ownership changes, it retained the neutrality that made it the default chip architecture for companies that would never buy exclusively from Intel or Qualcomm. A neutral transatlantic AI provider serves a structurally similar function. It is trusted precisely because it is not American and not Chinese. Here is where the thesis gets harder to hold. The €500 million commitment from Schwarz Group is large enough to be credible, but not large enough to sustain a full-stack AI training race. If the competitive moat is purely regulatory and not a genuine capability advantage, then the combined entity remains vulnerable the moment US providers build compliant European subsidiaries with local data residency. Microsoft's EU data boundary program and Google's sovereign cloud offerings are already attempting exactly that. The question is not whether Cohere Aleph Alpha has a real market today. The question is whether that market will still be theirs in 3 years.
Two scenarios are in play, and the evidence currently favors one, but not decisively. In the favorable scenario, the Cohere Aleph Alpha entity captures the sovereign AI procurement cycle as it accelerates through 2027. European governments are mandating data localization. Canadian federal departments are under pressure to avoid US vendor lock-in after months of tariff-driven trade tension. The Carney government's Invest in Canada summit, if it closes even a fraction of the institutional capital being pitched, provides a tailwind for Canadian tech infrastructure broadly. In this scenario, €500 million is the first tranche of a much larger capitalization,
and the company's valuation at IPO or secondary round becomes a legitimate comps exercise against Palantir's government segment multiples. In the unfavorable scenario, the merger is a defensive consolidation that delays, not prevents, irrelevance. If U.S. hyperscalers achieve genuine regulatory compliance in Europe, not just contractual promises, but certified local infrastructure, the sovereign moat dissolves. Cohere's enterprise revenues would need to be large enough to sustain independent R&D at frontier scale. They are not currently disclosed, which makes that assessment difficult. The evidence leans toward the favorable scenario, but conditionally. The condition is specifically this: whether the EU AI Act's high-risk system requirements, which take full effect in 2027, create procurement barriers that contractual data residency cannot satisfy. If they do, the Cohere Aleph Alpha model has structural durability. If they do not, the 500 million euros buys time, not permanence. The benchmark to watch is not a stock price. Cohere is private. Watch instead whether Schwarz Group converts its commitment into equity at a disclosed valuation before the end of 2026, and what multiple that implies against Cohere's enterprise ARR. That number, when it surfaces, will tell you whether the market believes the sovereign AI thesis or merely tolerates it. The deal is signed. The question it raises has not been answered yet.